Welcome to the GCV Weekly Briefing Podcast, where we break down the key financial and economic developments shaping the landscape for investors, businesses, and policymakers. The four stories we're looking at this week range from Monzo's IPO plans to the slowdown in the buy-to-let sector, the continued rise in zero-hour contracts, and a recent rebound in the US markets. We begin with Monzo, one of the UK's highest profile digital banks, making headlines again as it prepares for a potential public listing. The company is reportedly eyeing a £6 billion IPO, which could take place as early as next year. The listing location hasn't yet been confirmed, but London is currently in the lead, with Morgan Stanley expected to advise on the deal. Timing will be key here. Global conditions are still unpredictable, and it's likely to influence when and where Monzo finally lists. It's worth noting how far the bank has come. Monzo posted a 15.4 million pre-tax profit last year, after a 116.3 million loss the year before. That turnaround has really boosted investor confidence and put Monzo in a small group of profitable fintechs. Starling and Revolut are the others in that group. In fact, Revolut's last reported pre-tax profit was a huge 1.1 billion, with a private valuation of 45 billion. That tells us there's a strong interest in this sector, especially for firms that are now showing profitability. Monzo now has over 11 million retail customers and more than 600,000 business clients, making it the UK's seventh largest bank by customer numbers. That scale, combined with a shift to sustainable earnings, makes it a strong contender for a major IPO. Next, let's turn to the UK housing market, specifically buy-to-let. Activity in this sector has slowed significantly. In fact, now it's at its lowest point since before the 2008 financial crisis. What's the reason? Well, rising costs and tighter regulation are really pushing landlords to rethink. Landlords are now paying a 5% stamp duty surcharge, up from 3% that was introduced in 2016, and there's no sign of that reversing under the current Chancellor Rachel Reeves. For many landlords, the profit margins just aren't what they used to be. In response, some investors are moving away from high-cost areas in the south and looking to regions where yields are much stronger. The northeast, for example, now offers average yields of 9.3%, well above the UK average of 7.1%. A typical terraced house there might cost £150,000, nearly half what you'd pay in the south. In contrast, London is becoming much less attractive. Yields have fallen to 5.7%, and rents on newly let homes have been dropping for 5 months in a row. Only 23% of landlords raised rents on renewals this April, compared to 37% the year before. There's also more legislation on the way. The Renters' Rights Bill, currently in progress, aims to ban no-fault evictions and bring fixed-term tenancies. For landlords, that raises further concerns about how easily they can reclaim properties from difficult tenants. All in all, the picture is pretty clear here. Buy-to-let is under a lot of pressure, and many investors are already looking to more diversified property investment options instead. Now, let's take a closer look at employment. Despite repeated calls for reform, zero-hour contracts remain a fixture in the UK labour market, and the numbers are rising again. Between January and March this year, 1.17 people were employed on zero-hour terms, just below last year's record of 1.2 million. That's a 12.5% increase over the past year. This rise is especially notable given that Labour's proposed Employment Rights Bill includes plans to outlaw zero-hour contracts that don't guarantee work. Many employers are expected to pull back ahead of the reform, but instead it looks like some are doubling down before the rules change. The Work Foundation recently highlighted the risks of this model, pointing out that 3 in 4 people on the zero-hour contracts face what they call severely insecure conditions, including erratic hours, no benefits, and very little protection. Women account for over 80% of the recent growth in zero-hour roles, and young people under 25 remain the most likely group to be affected. But this isn't just a youth issue. Over 320,000 people aged 50 or over are also working under these sorts of contracts. Interestingly, many of these roles aren't as short-term as they're often portrayed. 2/3 of zero-hour contract workers have been with the same employer for more than a year, and some for over a decade. The Employment Rights Bill has passed its third reading now and is under review in the House of Lords, but implementation is not expected until late 2026. That means zero-hour contracts are likely to remain a significant feature on the UK job market for some time. Let's wrap up with a quick look across the Atlantic. The S&P 500 is now just 4% below its all-time high, having gained more than 6% in the past week alone. That puts it very close to a full recovery from this year's 20% drop. Some analysts are warning that this pace of growth might not be sustainable. They've noted that the rally appears to be driven more by sentiment rather than hard economic data. But still, others argue that this is a natural rebound after a long period of volatility. That said, uncertainty remains. Inflation, interest rates, trade policy, and global risks are all still in the mix. And while confidence is improving, many investors are still playing it very cautiously. As mentioned in previous episodes, a careful approach still very much makes sense, at least until there's more consistent evidence of economic stability. As we've seen today, there are a range of trends shaping our investing decisions, from the ongoing strain on UK landlords to renewed momentum in the US markets. That's all for today's update. Thank you very much for listening.